Come along for the ride.
Hello, my name is Anna Covert, and this is The Solar Coaster, the wild ride through the solar industry, told by the people who are living it every day. Alex, welcome back.
Thanks, Anna.
Imagine looking
yeah.
up at your roof, seeing those sleek, dark panels soaking up the sun, and feeling like you have finally bought into the future. You are saving the planet, you are cutting your utility bills, and you are riding the wave of the green energy revolution. It sounds like the ultimate win-win scenario, but what happens when the company that sold you that future simply vanishes into thin air?
It is a terrifying thought, and unfortunately, it is the exact reality for thousands of people right now. If we look at the landscape leading up to early 2026, we are seeing something that almost contradicts the entire narrative of the renewable energy boom. We have seen over 100 solar companies completely shut down. And we are not just talking about tiny fly-by-night operations. We are talking about massive multi-state giants.
That is exactly what we are diving into today. It is a massive paradox. For the last decade, solar was the golden child of the energy sector. Costs were plummeting, adoption was skyrocketing, and it felt like an unstoppable force. Yet, behind the scenes, this industry is experiencing a brutal, unprecedented extinction event. We are going to unpack why the solar boom suddenly went dark, the hidden financial mechanics that crushed these companies, and what this means for the everyday homeowner caught in the crossfire.
It really is a fascinating, albeit grim, case study. To understand the collapse, you have to look at the perfect storm of economic and policy factors that hit the industry simultaneously. It was not just one thing going wrong, it was the entire foundation of their business model cracking under pressure. And the first massive crack was the cost of money.
You are talking about the Federal Reserve and the interest rate hikes. It is incredible how a macroeconomic lever pulled in Washington can literally stop a solar panel from being installed on a house in Florida or Texas. Walk us through that domino effect. How exactly does fighting inflation bankrupt a solar contractor?
It comes down to the fundamental nature of how solar is sold. Solar is a high upfront cost product. Very few people are writing a $30,000 check in cash for a roof system. They finance it. For years, interest rates were essentially at rock bottom. So a solar salesperson could sit at your kitchen table and show you a financing plan where your monthly solar loan payment was actually lower than your current electric bill. It was a no-brainer. You flip a switch, you go green, and you save money on day one.
Right? The math did all the heavy lifting for the sales pitch.
Exactly. But when the Fed started aggressively hiking rates to combat inflation, borrowing became exponentially more expensive. Suddenly, that same solar system financed at a much higher rate means the monthly payment is now higher than the homeowner's current utility bill. The allure of solar as an immediate cost-saving investment just evaporated. Consumers looked at the numbers, felt the pinch of inflation in their everyday lives, and decided to hold off on taking on massive new long-term debt. Demand absolutely plummeted.
Which is a disaster for companies that operate on a growth at all costs model. If you are a contractor relying on a massive, uninterrupted pipeline of new installations just to keep the lights on, a sudden drop in consumer demand is a death sentence. But it was not just the consumers who were getting squeezed by high interest rates, was it? The companies themselves were caught in the exact same trap.
That is the second domino, and it was devastating. Solar contractors do not just sit on piles of cash. They rely heavily on borrowed working capital to buy equipment, pay their massive sales teams, and fund their day-to-day operations while they wait for projects to be completed. When the cost of capital surged, their operational costs skyrocketed. The larger companies had some financial buffers, but the small and medium-sized contractors, they were instantly suffocating. They simply could not absorb the increased costs of running their own businesses.
It is like running on a treadmill and suddenly someone cranks the speed to maximum while simultaneously turning up the incline. You are burning twice the energy just to stay in the same place, and eventually you just collapse. But wait, there is another layer to this financial chokehold that I find absolutely wild. The lenders themselves changed the rules of the game right in the middle of the crisis.
Yes, the shift in milestone payments. This is the operational nightmare that truly pushed many companies over the edge. Historically, solar lenders would release funds to the contractors in stages. You might get a chunk of money when the panels are installed, another chunk when the wiring is done, and so on. This kept the contractors' cash flow healthy. They could pay their crews and buy materials for the next job.
Makes total sense. You do the work, you get paid for that phase of the work.
But as the financial environment got riskier, the lenders got nervous. They changed the structure. Instead of paying out during those early milestones, lenders started holding back the bulk of the payment until the very end of the process, a stage called PTO, or permission to operate. And that is when the utility company finally comes out, inspects the system, and officially connects it to the grid.
Oh, wow. And getting the utility companies to come out and do those grid connections can take weeks, sometimes months, right?
Precisely. So now you have contractors who have bought the expensive panels, paid the labor to install them, and done all the work, but they are not getting paid by the lender for months. Imagine running a restaurant where you buy all the premium ingredients, cook a 5-course meal, serve it, but the customer's credit card doesn't process until 3 months later. You still have to pay your chef and your rent today. That delayed cash inflow created a vicious cycle of balance sheet stress that forced dozens of companies straight into insolvency.
That is staggering. It really highlights the fragility of an industry that relies so heavily on complex financial engineering just to function. But we cannot talk about this collapse without talking about the elephant in the room, the policy shifts, and specifically the absolute earthquake that happened in California.
California is the ultimate cautionary tale here. It is historically the largest, most lucrative solar market in the United States. But the introduction of the new net metering rules known as NEM 3.0 radically altered the landscape. Essentially, net metering is the policy that dictates how much the utility company pays you for the excess electricity your solar panels generate and send back to the grid.
And under the old rules, it was a pretty sweet deal for homeowners, right?
It was fantastic. You were essentially credited at the retail rate, but NEM 3.0 slashed those compensation rates dramatically. The math completely changed overnight. The payback period, the time it takes for the savings to cover the cost of the system, extended by years. The financial incentive to go solar in California was gutted.
And the fallout from that single policy shift is just breathtaking. We are talking about an 80% decrease in rooftop solar installation volume in the state, thousands of stalled projects, and the human cost is massive, over 17,000 industry layoffs. It forces you to ask a really uncomfortable, almost philosophical question. We spent a decade using government incentives to artificially accelerate this industry, creating tens of thousands of livelihoods. And then, with the stroke of a pen, the policy shifts and wipes them out. Are we treating the green energy transition like a genuine infrastructure necessity, or is it just a political experiment where the workers and consumers are the collateral damage?
That is a profound way to look at it. It is the danger of a subsidized market. When an industry's survival is dictated by legislative incentives rather than pure market economics, it is inherently vulnerable to political whiplash. The transition to clean energy is necessary, but the outright collapse of these fast-growing firms provides a very sobering lesson about the unintended consequences of how we manage these transitions. When you pull the training wheels off the bicycle too fast, the rider does not just wobble, they crash.
And speaking of the crash, let's look at the people who were left in the wreckage, the homeowners. You read the list of the companies that went under. It is a graveyard of major players. Companies operating across multiple states, massive California specific firms, huge operations in Texas and Florida. What happens to the family who signed a contract, had half a roof of panels installed, and woke up to find a padlock on their contractor's door?
They become what the industry calls solar orphans, and it is a nightmare scenario. First, you have the immediate uncertainty. Will the installation ever be finished? Who do I call? But even for people whose systems are fully installed and running perfectly, the bankruptcy of their installer is a ticking time bomb.
Because of the warranties.
Exactly. Solar companies sell peace of mind. They promise 25-year warranties on parts and labor, but a warranty is only a piece of paper if the company backing it ceases to exist. If an inverter breaks or a panel stops producing power 3 years down the line, these orphaned homeowners suddenly find themselves with zero support. They have to hunt down a new local contractor who is willing to service a system they did not install, which is often very expensive if they can find someone to do it at all.
That completely shatters the trust in the entire industry. If I see my neighbor struggling for months to get a broken solar panel fixed because their installer went bankrupt, I am absolutely not going to put panels on my own house. So, what is the lifeline here? If a homeowner finds themselves in this situation or wants to protect themselves before they buy, what can they actually do?
The first step is aggressive documentation. Homeowners need to have physical and digital copies of everything, their contracts, permit packets, data sheets, and interconnection agreements. Do not rely on an app or a portal that might get shut down. Second, you have to look beyond the installer. The actual manufacturers of the solar panels and the inverters usually have their own hardware warranties. You can often contact the manufacturer directly for replacement parts, even if the guy who bolted it to your roof is out of business.
But that still leaves the labor cost, right? The manufacturer might send you a new panel, but they aren't going to send a guy with a ladder to install it.
That is the critical gap, and that is exactly where the market is having to innovate. We are seeing the rise of specialized third-party risk management and extended warranty products. For example, there are models out there like the one pioneered by Era Agopian with Solar Insure that provide a safety net independent of the installer. It is essentially an insurance policy for your solar warranty. If your original contractor goes bankrupt, these third-party services step in, provide the monitoring, cover the service, and connect you with vetted contractors to do the repairs.
It is fascinating, really. The industry grew so fast that it outpaced its own safety mechanisms. Now, we are seeing the creation of an entirely new sub-industry just to manage the risk of the primary industry. It makes you realize that true maturity for a market isn't just about rapid growth, it is about building the infrastructure to survive the inevitable downturns.
That is spot on. And despite the sheer volume of bankruptcies and the very real pain caused by these closures, the underlying technology and the long-term necessity of solar energy remain incredibly strong. We are going through a painful, messy period of industry consolidation.
A shedding of the skin.
Exactly. The companies that survive this crucible, the ones with strong balance sheets, adaptable business models, and a genuine focus on customer security, are going to emerge much stronger. Technological advancements are still making panels more efficient. The broader cultural shift toward environmental consciousness isn't going away. The demand will stabilize and return, but the Wild West era of the solar boom is definitely over.
It is a classic tale of technological revolution. The pioneers take the arrows, the early adopters take the risks, and the market eventually learns its lessons the hard way. The solar industry isn't dying, it is growing up. And growing up is almost always a painful process.
It is. The key takeaway for anyone watching this space or considering putting panels on their own roof is that the era of blind trust is over. You have to look at the financial health of the partners you choose, demand third-party protections, and understand that you are not just buying a piece of hardware, you are entering a decades-long relationship.
A relationship that requires a lot more due diligence than we were led to believe. It leaves you with a lot to think about. As we continue to push toward a greener future, we have to ask ourselves not just what kind of energy we want to use, but what kind of resilient, sustainable business ecosystems we need to build to actually deliver it. The sun will keep shining, but as we have seen today, capturing that light requires a lot more than just good
Thanks for
intentions.
listening to Solar Coaster, the wild ride through the solar industry told by the people who are living it every day. My name is Anna Covert.
And I'm Alex Herrera. See you again next week.
Hop on a solar coaster, come along for the ride.
This episode of the Solar Coaster is narrated using AI-generated technology, representing Anna Covert and Alex Herrera. The material presented is aggregated from publicly available solar industry news sources. All commentary reflects reported industry developments and does not constitute personal opinions, investment advice, or endorsements by the hosts or
Solar
producers.
Coaster is proudly sponsored by Sun Energy Today, redefining what solar means for business and infrastructure. We engineer and deliver large-scale clean energy solutions, from megawatt solar farms to advanced graphene storage, designed for resilience, performance, and measurable return. Sun Energy Today, built to power what's next. Learn more at sunenergytoday.com.